Welcome to my channel. I am going to walk you through the process of valuing Unibail-Rodamco-Westfield stock and analyzing its financial ratios. Become a member of the channel and I can do a more in-depth valuation, or we can do a private Zoom session where I can show you how to analyze financial statements and answer any questions. See the link in the top of the description. Unibail's headquarters are in Paris. Its history originates with the formation of two separate shopping center operators. Unibail, founded in France in 1968, and Rodamco Europe, founded in the Netherlands in 1999. The company then acquired Australian shopping center operator Westfield Corporation in June 2018. This company is the largest commercial REIT in Europe. Its portfolio consists of retail property, office buildings, and convention centers within Europe and North America. We are going to look at the ticker that trades on the Amsterdam Stock Exchange because this company reports its financials in euros. But it also trades over the counter in the United States. And it trades on the Australian Stock Exchange and the Milan Stock Exchange. The valuation results will be the same regardless of which stock exchange I looked at. Let's get started with the model. This company has a market cap of 4.2 billion euros. So that's the value of the company according to the stock market. That's equivalent to 4.9 billion US dollars. They're trading at 30 euros a share. And to get the shares outstanding, its market cap divided by stock price gives you shares outstanding 139 million. Let's look at the financials. The way you value a company is you estimate the future free cash flows and then discount that number back to today's value. Free cash flow is cash flow from operations minus capital expenditures. The reason it's important that you invest in companies with positive free cash flow is because you want the company to have enough money to give you a dividend, to pay down its debt, to acquire another company, or to buy back shares. If you invest in a company with negative free cash flow, they can't do any of those things and they can't grow the business and make your stock price go higher and higher. If a company has positive free cash flow, that means it's generating more cash than it's spending. This company has positive free cash flow and it's really consistent. It's 1.6 billion, then it goes up to 1.9 billion. This company has a lot of free cash flow to work with to improve the company to make it even better. Net income is a profit and loss on the income statement. It's total revenue minus total expenses. This company has 2.4 billion of net income in 2016 and 17, and then a little over $1 billion in 2018 and 19. It may look bad that the net income goes down so much, but if you look at their revenue, it increases from 2 billion to 3.4 billion. So in 2016, they had $2 billion of revenue, yet they had 2.4 billion of net income. It doesn't seem to make sense because revenue is the top of the income statement. It's your sales. And then the bottom of the income statement is net income. So revenue is on top and all your expenses have to be taken out of revenue in order to come up with your net income. So net income should be lower. The gain or sale of real estate would not appear on your revenue section because revenue is your everyday operational business. It would appear on the income statement below revenue. That's why when you look at a REIT, PE ratio usually isn't the best indicator. Price over funds from operations per share is a much better indicator. So the 2018 and 2019 net profit margins are more indicative of the company because you usually don't have profit margins above 100%. Profit margins is net income over revenue. It's how well you convert revenue into profit. This company has 24 billion euros of debt. They pay 2.74% interest on their debt. And most REITs don't pay taxes, so their cost of debt is 2.74%. To qualify as a REIT structure, a REIT must distribute at least 90% of its profit out as dividends. And the people who receive the dividends pay taxes. This is how REITs avoid double taxation. Corporations pay taxes on its profits, then it distributes the dividends. And then the investors pay taxes on the dividends. That's where they got the term double taxation. Master limited partnerships also avoid paying taxes by distributing at least 90% of their profit out as dividends. This company has 47% debt in its capital structure, which means it has 53% equity. To get the cost of equity, we used a capital asset pricing model. And we need the beta to figure the CAPM out. The beta is how volatile the stock is relative to the market. And they have a pretty high beta, 1.74. The stock moves a little less than 2 times the European market, so it's a bit volatile, the stock. The higher the beta, the higher the cost of equity. You see the cost of equity is 15.68%. If I change the beta to 1, it goes down to 10%. If I change the beta to 0.5, it's 6%. So that's how you can see the higher the beta, the more risky the investment is and the higher return the investor seeks to receive. Their WACC is 9.65%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. Anytime a company takes on a new project, they estimate how much money they're going to receive from that project into the future, then they discount that dollar amount back to today's dollars, and they use the weighted average cost of capital, because that's how much money it costs this company to obtain financing, whether through debt and equity. And we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 9.2 billion euros. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of 13.2 billion euros. We divide that by 139 million shares. And we get a calculated intrinsic stock price of 96 euros. They're trading at 30 euros, so they're trading at a 68% discount. It's a strong buy according to the model. Simply Wall Street values this company at 88 euros, so a little less than me, but still a strong buy. Let's see where the stock has been trading at the past few years. So before the market crash, it was trading well over 100 euros and over 300 euros a few years back. The price keeps going down and down. This looks like a really great value. Let's look at the financial ratios. So PE, although it's not the best indicator for a REIT, I still like to look at it anyways. They have a really low PE of 3.8. The median is 16.5. The average is 18.9. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 3.8. So investors are paying $3.80 for $1 of earnings. Price of sales is also really good. The median is 1.9. The average is 4.7. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 1.2. So investors are paying a little over €1 for €1 revenue. They have a really good price to book. The median is 2.4, the average is 4.8. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. And I like to see below 3.5, they're at 0.2. So investors are paying €0.2 for €1 book value. Remember, equity is total assets minus total liabilities on the balance sheet. Good interest coverage ratio, that's EBIT over interest expense. I like to see above 2.0, they're at 2.9. EBIT is earnings before interest and taxes, also called operating income on the income statement. Low ROE, the average is 14%, the median is 12%. ROE is net income over equity. I like to see above 20%, they're at 4%. They have a low current ratio, the median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 0.8. They're a little shy in covering their current debts and payables. The best way to look at ratios to compare them to similar companies, I've done videos on Gree Realty, Federal Realty, the Macerich Company, Realty Income, RioCan, which trades on the Toronto Stock Exchange, Tanger Outlets, Simon Property Group, Seritage Growth Properties, and Washington Prime, all in the same industry as Unibail. And if Unibail has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So price over funds from operations per share is something you need to look at when valuing a REIT. And I like to see below 15. The average is 8.2. They're at 26. So investors are paying 26 euros for €1 of funds from operations. Funds from operations is net income plus depreciation and amortization minus the gain on sale of real estate. Their PE ratio is the best of all the companies at 3.8. Their price to sales ratio is much better than the average. They have the best price to book of all the companies. Their current ratio is lacking at 0.8. The average is 1.1. Their ROE isn't good either at 4%. The average is 14%. Their debt is better than the average at 47%, average is 61%. Their market cap is $4.9 billion US dollars when I convert it. The average REIT in the industry is 6.1 billion, and they don't pay a dividend. The average is 3.85%. The highest is RioCan at a whopping 9.6%. So if you live in Canada, get some RioCan. So to summarize, I have been trading at a really deep discount. Their ratios look pretty good, but their financials are really solid. So let me know what you think of the video. Leave a comment. I reply to all comments. Become a member of the channel and I could do a really full in-depth valuation, or we can do a Zoom call and talk about financials. Thanks for watching.